In the last 48 hours, silver has lost almost $5. It went from trading near $66 on Monday morning to sitting near $61 by Wednesday. That's one of the sharpest two-day drops we've seen since the crash we talked about a few videos back. And here's the part that's going to genuinely surprise you. A huge piece of this drop is connected to something that sounds like it should be good news. Peace talks, actual diplomatic progress, the kind of headline that's supposed to calm markets down, not wreck them. Today I'm going to show you exactly why good news turned into one of silver's worst stretches in weeks. And I'm also going to take you somewhere most silver channels never go, into the Indian commodity market. Because what happened there in the last 2 days actually tells you more about this crash than anything happening on Wall Street. Stick with me, because by the end of this video, you're going to understand this drop in a way almost nobody else is explaining it. Let's get into it. This is OG Silver Stacker. Fresh information every single time, no recycled talking points. Let's go. Let's start with the genuinely strange part of this story, because it's the key to understanding everything else. Earlier this week, the United States and Iran held formal high-level talks in Switzerland, with Qatar and Pakistan acting as mediating nations. Both sides reportedly agreed to what's being described as a 60-day peace roadmap, a structured timeline aimed at de-escalating months of regional conflict. On the surface, this is a major diplomatic breakthrough, and for most assets in the market, it was treated exactly that way. Stock markets responded positively. Oil prices fell, government bond yields eased. By almost every normal measure, this looked like a textbook risk-off relief moment, the kind of news that's supposed to calm jittery markets down across the board. But silver did something that confused a lot of casual observers. Instead of calming down alongside everything else, silver kept sliding. And over the following 2 trading sessions, it lost nearly $5. Here's the mechanism behind that paradox, and I want to walk through it carefully because it's genuinely one of the more counterintuitive dynamics in commodity markets. Part of silver's elevated price over recent months had been propped up by a geopolitical risk premium, essentially extra value baked into the price, specifically because of fear surrounding the conflict. Fear of oil supply disruption, fear of broader regional instability, fear that things could escalate further. When real diplomatic progress emerges, that fear premium doesn't just disappear gently. It often gets unwound fairly aggressively and quickly, because the traders who had been holding silver, specifically as a hedge against escalation, suddenly have much less reason to keep that hedge in place. They sell, the price drops, and because so many of these traders are reacting to the same headline at roughly the same time, the selling can become surprisingly forceful, even though the underlying news is technically positive for the broader world. At the exact same time, there's a second, more subtle effect working in the same direction. Part of the reason traders were buying silver during the conflict wasn't purely about fear and safety. It was also about anticipating potential industrial supply chain disruptions if the conflict worsened. Things like shipping delays, energy cost spikes affecting manufacturing, and general economic uncertainty. With that escalation risk fading because of the peace roadmap, some of that anticipatory buying unwound too. So you ended up with both the safe haven premium and a layer of escalation hedge buying unwinding simultaneously, which is part of why this particular good news event hit silver harder over these 2 days than you might initially expect. Here's an interesting wrinkle that helps confirm this entire theory. Gold, during the same window, actually held up considerably better than silver, in some sessions even posting modest gains while silver was sliding sharply. If both metals were simply reacting to the same fading fear premium in an identical way, you'd expect them to move in the same direction by similar magnitudes. They didn't. And the reason connects directly back to something we've discussed before on this channel, the fundamental difference in what these two metals actually represent to different types of buyers. Gold's buying base skews heavily towards central banks, large institutional reserve managers, and long-horizon monetary hedgers. The kind of buyers who don't typically react with the same speed or intensity to short-term diplomatic headlines. Silver's buying base includes a much larger proportion of shorter-term speculative traders and industrial hedge participants, the exact group most likely to unwind positions quickly the moment a specific geopolitical catalyst, like this peace roadmap, materializes. This is part of why silver experienced a sharper, faster reaction over these 48 hours, while gold essentially shrugged. And, in some sessions, even found modest support from falling oil prices easing broader inflation worries. There's also a detail specific to this week worth mentioning. Reports indicate that diplomatic progress helped ease broader market concerns following a separate earlier round of threats exchanged over the Lebanon conflict, where Iran had claimed it, once again, closed the Strait of Hormuz. Yet even during that claimed closure, millions of barrels of crude oil continued moving through the waterway without serious disruption. And Gulf oil producers were already preparing to increase output regardless. This created a scenario where the actual physical reality on the ground was calmer than the rhetoric suggested, which made the eventual diplomatic breakthrough feel less surprising to longer horizon gold buyers, and more like a final confirmation to shorter horizon silver traders that it was time to exit positions they'd built specifically around escalation fears. Now let's go somewhere almost no other silver channel is taking you this week, and that's directly into the Indian commodity market. Because what happened there over these same 48 hours adds a genuinely important piece to this puzzle. India operates its own major commodity exchange called the MCX, the Multi-Commodity Exchange, where silver futures trade actively in Indian rupees rather than US dollars. On Tuesday alone, MCX silver futures for July delivery dropped over 4% in a single session, falling sharply from the previous close. This is significant because India represents one of the largest physical silver consumption markets on the planet, driven by jewelry fabrication, silverware manufacturing, and investment demand tied to cultural and religious traditions throughout the year. When the Indian market reacts this sharply, it's not just noise. It's a reflection of how one of the world's largest groups of actual physical silver buyers and traders is processing the same global news we've been discussing. Here's where it gets even more interesting. During the same window, India's volatility index, essentially a measure of how much uncertainty and nervousness exists in Indian markets broadly, surged by close to 11%. That's a substantial jump, and it reflects a broader wave of uncertainty hitting Indian markets simultaneously, not just silver in isolation. Part of this coincided with a separate, unrelated event, the weekly expiry of Bank Nifty options, a major Indian banking sector derivative contract, which added its own layer of volatility to Indian markets that particular week, completely separate from anything happening with silver or geopolitics specifically. When multiple sources of volatility stack on top of each other like this, in different markets at the same time, it tends to amplify price swings beyond what any single factor would produce on its own. Let's dig into something genuinely technical but important here, because it directly explains part of why this particular week has been so unusually volatile, separate entirely from the Iran peace news. The active MCX silver futures contract that most Indian traders use is set to expire in early July. As any futures contract approaches its expiry date, traders who are still holding open positions need to make a decision. Either close out their position entirely or roll it forward into the next available contract month. This rolling and unwinding process tends to add extra directional pressure to price action in the days leading up to an expiry, separate from whatever the real fundamental news of the day happens to be. Large traders adjusting their positioning ahead of expiry can create what's sometimes called expiry-driven volatility, where price swings become exaggerated not because of new information entering the market, but simply because of the mechanical process of large positions being closed out, adjusted, or rolled forward, all within a relatively short window of time. Analysts covering the Indian market specifically flagged this pre-expiry positioning unwind as a meaningful contributor to Wednesday's continued volatility, layered right on top of the broader Iran-related selling pressure we discussed earlier. This is a genuinely useful concept to understand even if you never trade futures contracts yourself, because it explains why price swings sometimes seem disproportionate to the news driving them. Part of what you're watching during weeks like this isn't pure sentiment about silver's future value. It's a mechanical traffic jam of expiring contracts, options positioning, and rollover activity all happening simultaneously, adding noise on top of the signal. Here's another India-specific thread worth pulling on. Because it's been quietly developing in the background for a while now without getting much attention from Western silver coverage, earlier this year, India implemented a meaningful increase to its import duty on silver. A shock that initially made imported silver noticeably more expensive for Indian buyers and briefly dampened import volumes as the market adjusted to the new cost structure. Recent reporting suggests that this duty shock is now in the process of normalizing, meaning the market has had time to adjust and absorb the new cost structure. And import patterns are gradually settling into a new, stable baseline, rather than continuing to actively disrupt trading activity the way they did when the duty change was first announced. This matters because India's import behavior is a meaningful swing factor in global silver demand. When Indian import duties spike unexpectedly, it can temporarily suppress demand as buyers and dealers adjust pricing and sourcing strategies. As that adjustment process completes and normalizes, demand patterns tend to stabilize, and, depending on underlying price levels, can sometimes accelerate again. As buyers who had been sitting on the sidelines during the adjustment period return to more typical purchasing behavior, with silver prices now pulling back toward the low $60 range, there's a reasonable case that this normalization process, combined with lower absolute prices, could actually encourage increased Indian buying interest over the coming weeks. Exactly the kind of dynamic we discussed in an earlier video where price-sensitive Asian buyers have historically treated dips as buying opportunities rather than reasons for panic. This is a slower moving, less dramatic story than the headline-driven swings we've focused on elsewhere in this video. But it's exactly the kind of background demand factor that can provide a meaningful cushion underneath silver's price, even during a rough stretch like this one. Let's revisit the gold-silver ratio concept we've covered before, because it just shifted in a way worth flagging clearly. The ratio currently sits around 63.2, meaning it takes roughly 63 ounces of silver to equal the value of 1 ounce of gold. This represents a meaningful move higher from levels closer to 61 or 62 that we discussed in earlier videos, which tells you silver has actually been underperforming gold on a relative basis during this specific stretch. Exactly consistent with everything we've walked through about silver absorbing a sharper hit from the unwinding fear premium than gold experienced. This matters for how you interpret this entire 48-hour move. A rising gold-silver ratio during a period of falling prices tells you that silver's drop has been driven by something specific to silver's particular buyer base and market structure, rather than some broad, universal flight away from precious metals as an entire asset class. If both metals were falling by similar percentages, the ratio would stay roughly flat. The fact that it's climbing tells a more nuanced story, one where silver's heavier concentration of short-term speculative and industrial hedge positioning is taking a disproportionate hit compared to gold's steadier, more institutionally anchored buyer base. Historically, when this ratio climbs during short-term corrections like this one, it has sometimes set up exactly the kind of catch-up move we discussed in an earlier video, where silver eventually outperforms gold again once the specific catalyst behind the divergence, in this case the rapid unwinding of geopolitical fear premium, fully plays out and stabilizes. That's not a guarantee of what happens next, but it's a useful pattern to keep in mind rather than assuming a rising ratio is automatically a permanently bearish signal for silver specifically. Let's check back in on that algorithmic forecasting model we mentioned in an earlier video, because its numbers have shifted along with this week's price action. And I think it's worth addressing directly rather than ignoring it. The latest update from this particular forecasting model now projects silver falling to around $61 within the next week, and reaching somewhere near $46 by the end of this year, which would represent a substantial further decline from where we sit today. I want to be straightforward with you about how to actually use a number like this rather than either dismissing it entirely or panicking over it. As we discussed previously, these short-term algorithmic models are heavily influenced by recent price momentum, meaning a few days of sharp declines, like the ones we just experienced, will mechanically push the model's near-term forecast lower, simply because it's extrapolating the recent trend forward. This doesn't make the forecast useless, but it does mean you should treat it as a reflection of recent momentum rather than an independent, fundamentals-based prediction about silver's true long-term value. The genuinely useful way to use a forecast like this is as a kind of sentiment thermometer. When you see the algorithmic bearish target shifting lower in direct response to a sharp 2-day drop, it tells you that short-term momentum has turned decisively negative, which is useful, real-time information about market psychology. What it doesn't tell you is whether the underlying supply deficit, industrial demand growth, or 6-year structural shortage we've covered extensively in previous videos has changed in any way. Those slower moving fundamentals haven't budged at all this week, even as the short-term momentum-based forecast has shifted meaningfully lower in response to recent price action. Let's tie in one more piece of this puzzle, because it connects directly to where silver might head over the coming days. With diplomatic progress, reducing geopolitical uncertainty, and oil prices easing as a result, there's a reasonable case building that this could eventually soften some of the inflation pressure that's been feeding into the Federal Reserve's hawkish stance over recent weeks. Energy costs have been a major contributor to recent inflation readings. And if oil continues trending lower as the peace roadmap holds, that could gradually ease some of the pressure that's been pushing Fed officials toward additional rate hikes. Here's the layered, somewhat contradictory reality, though. In the very short term, this exact same de-escalation is what triggered silver's sharp 48-hour drop, through the fear premium unwinding mechanism we discussed at the start of this video. But if you stretch the timeline out a bit further, easing inflation pressure from lower oil prices could eventually translate into a less hawkish Fed stance, which would historically be supportive for silver through the interest rate mechanism we've covered in previous videos. In other words, the same underlying development, genuine progress toward de-escalation, is working against silver in the immediate, short-term sense, while potentially working in silver's favor over a slightly longer horizon, depending on how inflation data actually evolves from here. This is exactly the kind of layered complexity that makes silver such a genuinely challenging asset to trade on short-term headlines alone. But it's also exactly why long-term stackers who focus on the structural deficit story tend to weather these kinds of confusing, contradictory weeks with far less stress than short-term traders trying to predict every twist and turn of the news cycle in real time. So pulling this all together, here's how I'd think about positioning yourself through this particular 48-hour stretch and the days immediately ahead. First, recognize that this drop has a clearly identifiable specific cause: the unwinding of a geopolitical fear premium following genuine diplomatic progress, combined with India-specific options, expiry mechanics adding extra short-term volatility on top. This isn't a mysterious, unexplainable collapse. It's a fairly well-understood reaction to a specific catalyst, which should make it less frightening than a drop with no clear explanation at all. Second, watch that gold-silver ratio over the coming days. If it continues climbing significantly beyond where it sits now, that would suggest the fear premium unwinding still has more room to run. If it starts stabilizing or reversing back lower, that would suggest silver-specific selling pressure is exhausting itself and a relative recovery against gold could be building. Third, keep an eye on how India's import duty normalization plays out over the coming weeks, particularly given that lower absolute prices right now could genuinely encourage a pickup in Indian physical buying, providing a demand cushion that doesn't depend at all on what happens with the Federal Reserve or geopolitics going forward. Fourth, treat the algorithmic bearish forecast as a momentum gauge rather than a fundamentals-based prediction. And keep your attention on the structural deficit story that hasn't changed one bit despite this week's sharp price action. So here's the real story behind silver's worst 48 hours since the crash we discussed earlier. It wasn't really bad news that caused this drop. It was good news. Specifically, genuine diplomatic progress between the US and Iran, triggering a rapid unwind of the fear premium that had been propping up silver's price during months of conflict. Layer on top of that some India-specific options, expiry mechanics adding extra short-term noise, you get a genuinely sharp, fast-moving 2-day decline. That looks scarier in isolation than it actually is once you understand the specific mechanism driving it. None of this changes the structural deficit story, the industrial demand growth, or the supply constraints we've covered extensively on this channel. What changed is sentiment around a specific geopolitical catalyst. And sentiment, as we've discussed before, tends to move much faster than the slower moving fundamentals underneath it. If breaking down exactly why good news can sometimes hurt silver is the kind of nuanced analysis you actually want from this channel, hit that like button, subscribe so you catch the next breakdown, and let me know in the comments, did this peace deal paradox surprise you, or had you already figured out something like this was happening? I read every comment, and I'll see you in the next one.